Hi everybody, this is Seth Martin with the Middle Class Investor. Thank you for visiting today. Well, today's the 16th of April, the day after tax day, and we've had three pretty strong days in the market. We'll zoom in here and show you. Let's go to a daily chart, and let's go ahead and get right to it. Zoom in on what's happened and talk a little bit about it. So I've got the rising wedge on here that we've had here for a while. This is our old support box, and we talked about last time. This was Friday, the day that it sliced through this support box, and we talked about it. This lower trend line likely holding, either coming down and touching it and bouncing, or maybe stopping short of it and bouncing. So and we also talked about how this is narrowing. The rising wedge is getting narrower and narrower. So what that means is traders, institutional traders, the big money, it's becoming more and more difficult for them to capture, a trend and make some money, whether it be capture a trend this way or capture a trend back down to support this way. And eventually, the nature of the rising wedge is that you tend to break out of it to the downside. So that's kind of what we're looking for to happen. We don't know when it'll happen. We're not predicting that it's going to happen tomorrow or even next week or even next month, but eventually, probably within the next several months or sooner, this will play out and break down through this for some sort of correction. So here's our old support box that we crashed through. I've drawn a new support box here on the screen just below the most recent lows, and we've got a real strong move. We had a low, we had an inside day or a harami, a bullish harami form, and we've bounced, and we've got a pretty strong move upward. Now, we've talked about this before, but the market doesn't just go straight up. So although it did back here, it kind of just went straight up. But this is not, this is not typical. So, we're probably gonna see, maybe a slight pullback, and then a bounce up, and then we'll probably get up to this upper trend line, or close to it, and make new highs in the market. So I think that's the high probability move at this point. As we say, there's a mean price action that runs kind of through the middle of this, and what traders are looking to do is typically what they're looking to do is to trade from the trend line back to the mean. If you get a breakout of the trend line, then they trade from this trend line to the next trend line, and then they trade down from a trend line down back to the mean. That's how traders work. So, like we said, as this narrows, the amount of money a trader can make going forward is less and less dollars. So this has a direct impact on you and your 401k. Your 401k investments pretty much track the S&P 500, which is the chart I have on the screen here. And so, it's the reality that we all deal with, okay, inside our 401ks or IRAs. It's what governs what's happening in the market. Yeah, there's fundamentals and there's earnings per share and there's this and there's that, but at the end of the day, someone's ability to make money is what drives, whether there's net buyers or net sellers, okay? So anyway, this is kind of what we're dealing with at this point. What I want to do is I mentioned right here that this was a a bullish harami. And so what I did is I pulled up this is a drawing of an example of a bullish harami. This is coming to us courtesy of OnlineTradingConcepts.com. I just went to the internet and these guys were there. So let me zoom out a little bit. Okay, so what we have is we have a downtrend. This is basically the scenario that we're going through right now. So we had a downtrend. The market made a low. This low marked by the number 3 here. It says well, it says gap up, but maybe that one over there. But oh, they're talking about the green arrow is a gap up. Yeah. So this is an inside day. So you can see that the entire body of this green candle is inside the entire body of the red candle. That's an inside day, or what's potentially could be a bullish harami. Now, it's not actually a bullish harami until you get a break above the high of the green candle in this case. So in this particular example, it broke above that, it pulled back a little bit, and then it took off to the upside. And you can see it kind of zigzagged its way up here. And then here at the top, we had a bearish harami. So we had a high, we had an inside day, or where the range fits inside the previous day's range, and then we had confirmation of the bearish harami by the market selling below the low of the inside day. And then you can see that the trend continued down. So this is just an example. You can go to the internet and find a lot of examples of candlestick patterns. The harami is a pretty common one. It always happens at the bottom of a downtrend or at the top of an uptrend. You can't. It's not something you like. This right here is not a harami by the strict definition. So it's not something that you're going to see in the middle of a trend. It's always at the end of trends, whether they're down or up. So anyway, I just thought I'd throw that in there. Something else that before we go to that something else, let's look at the bond market real quick. Most of you know this is something I've been harping on quite a bit lately. So as the market sold off, this is the interest rate. So that means the bonds were up. When the interest rates go down, the bonds go up, and we're looking for the interest rates to pull back into this box, maybe even slightly lower, maybe further down here to 2.4%. There's a little trend line down there that's not on the screen, but so look for that to happen. And what I've been saying is, if that does happen and you are in bond funds, you should probably take that opportunity to get out of those bond funds. That's not a recommendation. That's just what I would do in my own IRA. That's what I'm doing. So, but a lot of people, the reason I mention this, because the news is a lot of people have moved into bond funds, a lot of older people especially, because they need income. Okay, so bonds, the way bonds are structured is they provide, yield. You'll hear the term high yield, and so you can buy a bond and you can get a guaranteed rate of return of 4% a year or 6% a year or whatever the details are on the particular bond. And all the bond markets, the corporate bond markets, the government bond markets, they're all sky high, and at the end of long-term cycles. So just be careful with the bond markets. Let's go back to the S&P 500 real quick. We'll go ahead and put up a MACD. The MACD, as you recall, we've talked about it before. It's an oscillator. So you can see it kind of measures momentum, or the internal momentum in the market. And so you can see that during this period right in here, momentum was declining. So let's well, I can't fit that on there, so I'm not going to do that. But during this from about mid-February to now, momentum has been declining, but the general market has been drifting upward. So that's what we call a bearish divergence. It doesn't mean that the market has to go down. It just means that it's kind of running out of steam. And as this rising wedge narrows, we would expect that. Even today, let's see if we can put volume on here. I don't know. I don't think there's volume. No. If we look at the Dow, let's put the Dow up real quick. I don't have the bearish rising wedge on the Dow, but you can see the volume here. Even though we had a pretty strong up day, and this is pretty typical across the markets today, even though we had a really strong up day today, 1% up day, it was on slightly lower volume. You can see this volume candle right here. Now the blue line is a 30-day average. So price and volume pretty much drive the trend. So if you look at this down day, look at these down days right here. There's a down day here, and there's a down day here. Both of these days were down on higher volume than any of these days went up on volume. So it's just something to look at. It doesn't mean the market's going to crash tomorrow or anything like that. It's just something to be aware of. They're just little signals that you can look for to kind of give you pause, or to give you caution. If you're about to do something, you might want to wait. I mean, the market is always going to give you opportunities. There's nothing wrong with waiting until the signals are a little bit better. That's certainly doable. Now, one of the things I wanted to talk about today, I do watch the news and I listen to what's going on in the popular culture. And one of the things we're hearing a lot about is, the disparity, the income disparity between, the richest Americans versus those Americans that don't have as much. So what I've got on the screen here, and it's not the greatest picture. This is a historical average of the percentage of the top 10% income earners as compared with the total income generated in the United States. So what we see here is that in the 1910 to into the late 1920s, this income disparity rose up. Okay, so the top 10% income earners earned almost 50% of the total income that was earned in the United States. Of course, then we had the market crash, and then the Great Depression, and this all throughout the years of the war, it stayed pretty much in this range. And then, ironically enough, in 1972, this started to change. This is where inflation has really kicked in. I guess you could look at it that way. We went off the gold standard. We printed. You can see this big time. It started to move up in the 80s and whatnot here. And so this was the dot-com bust. So the richest 10%, they took a hit. And if you think about it, it makes sense, right? The richest Americans own a lot of things. They own apartment buildings, they own businesses, they own all kinds of stuff that generates income. And generally speaking, when there's a recession or there's a decline in the economy, the rich lose the most. I mean, they just the nature of being rich. Now, they don't lose so much that they're living on the street. They just lose a big chunk of what they had in wealth. So anyway, you had the dot-com, crash here, and then we ran up for a while. Then you had the financial crisis, and we've been running up for a while. Okay, this is the interesting thing about this is most people haven't even looked at this in years. But what's happening is it's so much in the media now that people are starting to look at it, and it's just interesting that it's reached a level that it's not seen since the Great Depression. So there's kind of a self-correcting thing that happens in the economy here, and if you're lucky enough to be rich and you're listening to me now, you might you might think about this a little bit and think about how you might protect yourself. Someone like a Warren Buffett is going to lose a lot if we have another situation like this. Mainly just because he has a lot. Okay, and he's not going to be living on the street. But if you're worth $50 billion and your wealth gets cut in half, you're worth $25 billion. So that's a big drop in that share of the income, the national income, if you will. It has a big effect on it. So that's why these numbers drop off so drastically. So anyway, just something on that. It's been in the news a lot. I thought I would comment on it. I saw this graph. I thought it would be useful to look at. So I guess that's it for the week. We could, if you want, we could spend a little bit more time talking about this. There's something that maybe that would be useful to talk about. If this pulls back, so it's the same rules we've been using. Okay, let's say that you're more of a trader and you want to get in gear with this trend. If this pulls back to a higher low, so it pulls back to a low somewhere in this area or higher, and then you get I'll tell you what, let me do this. Let me do a little drawing here. So let's say that we get a pullback, and you get something, a candle that looks like that, maybe looks like that, and maybe that's as far as down as it goes. Let's say it doesn't go down any further than that, and then maybe you get a candle that is just kind of stubby and doesn't really do anything. And again, if you recognize this would be a harami. But I'll tell you what, let's forget about the harami, because I don't want you to think that it always ends in a harami. But let's say you had something that let's say it just came down to here and did that. Well, this would be an area you would re-engage with the trend, right? The downtrend has come to an end. You're getting a buy signal right here at this level, and what you'd be looking for is for the market to continue to move up, right? Maybe it kind of does this, and maybe you get something like this. Maybe you get a big day like this, so on and so forth. And then when it gets up here, let's say that you have some more days like this or whatever. And then when it gets up here and it starts making little ones like this, maybe it even makes one that just looks like a line almost, like this. And you might get a situation where it kind of pokes out like this. And then you get a day that looks like this. Well, this is signaling the end of the downtrend. So this is, if you remember, we've talked about this before. The market opened, the bulls pushed it all the way up, the bears pushed it all the way back down. The next day it opened up and sold off. That's the end of that's the end of the uptrend. Okay, so just kind of watch. When you're looking at this, most of you have never looked at this with this kind of eye. You just say, yeah, it went up, it went down. You hear the news. It says the market was up on X, fill in the blank. Yeah, that's kind of true, but not really. I mean, that's really the media picking out what they thought was important. You know, Google earnings were good, and so the whole market was up on Google earnings. Well, not necessarily, okay? That's just what we've become accustomed to hearing. But that's not really what moves the market. Now, earnings can move the market in a particular stock or sector of stocks if they all announced on the same day and things like that. But what moves the market are the participants trading the equities. Either they're trading more aggressively to the upside or they're trading more aggressively to the downside. The numbers of buyers and sellers of actual shares is the same. It's how aggressively are they trading in any one direction. That's why volume is important, and price. Those are the two most important things. So just I still think it's time for caution. You know, it's not like you want to take all your savings and push it into the market. But if you're trying to capture, you know, the rest of this uptrend, if there's more to go, then, you know, just be smart. You know where your support line is. It's down. There's actually two support lines, right? There's the actual line here, which is, you know, this blue line right here. But then the other support is our blue box, right? So these are the two areas of support. So if the market comes down and it breaks through the blue line, you know, you should see yellow. Okay, caution. And maybe it retests and it comes and it really blows through this support box. You know, that should be another area of caution. So just be smart about it, and you know, if you got questions, you know, you can, on the video, there's a place where you can comment. I'm on Twitter. You can tweet me at InvestorClass, or you can search on Middle Class Investor. Either way, you can get to me on Twitter. We can go back and forth, discuss certain things, or do it through the YouTube video. So that's it for Wednesday, April 16th. Look forward to seeing you guys again. Thank you for coming in and watching the video. If there's anything, if I can tailor the video to a certain line of thinking, or certain types of equities, or certain types of investment instruments, please give me that feedback. I need that feedback. I want to be talking about the things that people in the marketplace are interested in. I don't want to just talk about things that are only important to me. So please give me that feedback. Go to Twitter at InvestorClass, or, you know, comment on the YouTube channel, and let's discuss it. All right. Have a great week and a happy Easter to everybody. Hopefully you're all off on Friday, Good Friday, and you can be with family on Sunday and remember what Easter's all about. And hope to see you again in the Middle Class Investor. Thanks for coming in today, guys.